Another one, and like this question, somebody's asked us that I'm in the mid 50s and I'm a first home buyer, and what should I go for? A principal place of resident, or I should go for an investment property? I'll take that. I'll to with all respect, see, it's fun is it's nothing to do with the age. It's more to do with what you want to do. There are times where families have come back to us and have said that uh, investment really makes sense for us, but emotionally, I need a place to live in. I'll feel settled if I have a house and I can walk into the door. I open the door in the evening from my work after I'm tired, and I feel welcome and I just feel relaxed. I want to have that feeling. Investment can be on the side. Totally respect that. That's the way we all have thought and we think at a lot of times. And that's when you should go for a PPOR. But if you say, I don't really mind, I want to stay in the best suburb, which I may not be able to buy in, I'm happy to pay the rent there. And I want to still ride the wave of investments and still ride the wave of property cycles moving up. Investment is for you. It's an individual. It's goals which you really want to achieve and goals which you want to go for, which drives your decision about whether you should go for an owner occupied or investment. You're not too late for anything. Age is not an issue in this. It's more of your objectives. What happens when you have equity but have exhausted your borrowing power? All right. Extremely common scenario today because of these high rate of interest. You have so many people who will come and say, my house is worth $2 million, $1 million. My loan is only $500,000. I have equity. Can I buy another investment property? Unfortunately, that's not how borrowing capacities work. It's as simple as that. Without to tell you, if you have no income but you have no loan on your house, will anybody give you any money? You most likely no, because you won't be able to repay. And that's where borrowing capacities come in. Unfortunately, if you don't have the income, if you don't have the borrowing power, there's not much you can do. But what you can do in these scenarios is you have to really evaluate how far and what options have you chosen to get your borrowing power in place. Have you looked at all the options? Which means sometimes people will stop at the top 4 banks to see whether I have borrowing capacity or not. We can look at much more options. Many other lenders which are there, smaller banks are there, non-banks, some really phenomenally great non-banks which offer great value are there, not too expensive are there. Then there are the second tier non-banks which are there, which can help you borrow if you're really looking to borrow. Then there are options like borrowing under an SMSF. There are options which people follow for SMSF. The option people follow under trust. A lot of things available. If you've exhausted all of them, then obviously you'll have to wait for interest rates to come down. But if you've not exhausted, then you can just reach out and we can help you understand how much your borrowing capacity can be. Which property is better in SMSF, positively geared or negatively geared? Okay, as I was talking at the in between, and it's a question which requires more discussion, but broadly, we're looking at negative gearing when you are wanting to save tax and the tax benefits which come along with negative gearing. In super, the tax rate is not high. So you're not sitting at a 50% tax rate or a 40% tax rate or all of this. I don't want to get into an accountant's boundaries, but broadly, the tax benefit comes with capital gains. The tax benefit comes with lower tax rates, which are already there in your SMSF. So when it's already a lower tax rate, a negative gearing does not really take you too far. The more positively geared you are, the more chances of a property having capital gains. It looks better in that scenario. Having said that, you may still have a negatively geared property if you feel that there will be a great capital gain scenario. So you're going into it for the long term. And SMSF investment is actually a long-term basis. So you can still opt for either of them. We need to really discuss out maybe the properties, maybe your investment goals and how you would want to look at it. And happy to have a chat on this as much as you can and to try and understand your particular circumstances and give you an advice on that. Okay, do Big Four give loans for SMSF and what kind of interest rates exist? All right, a few years ago, we had the banks barred from giving loans to SMSFs. So you will not find any bank which is available in that space. You will find only non-bank lenders which are remaining in that space. Non-bank lenders are, so no big four, no, they are not there at all. The non-bank lenders, some of them are really big ones like Granite and AFGs and then First Mac and Resimac and Pepper, and a lot of the big guys are there, which are non-banks but are operating in this space, and you can take benefit from any of these. Interest rates typically about at an 80% loan level, you'll have most of the lenders at around 7.5% today. It will decrease or change hopefully after this RBI rate announcement. But yeah, that's where you're sitting at about 7.5%. Depends on various lenders. Some will have fees, some will have other structures, some will have cost structures, discharge fees, and all that stuff. When you sit with a mortgage broker, they will be able to explain to you, or you can call us and we can explain to you how it works and what kind of fee structures are there. In your super, can I buy properties which I can flip and enjoy the capital gains benefit? Julius? So if you're looking to buy properties to flip, okay, again, it's purely about strategy. So when you're looking properties to flip, you have to understand when you want to flip, you will want to enhance the value of a property. When you're looking to enhance the value of a property, you're going to do some kind of a construction. You're going to do some kind of a thing in it, some kind of an improvement in it. And as we were discussing at the earlier stage, it's not so easy to do construction. It's not so easy to, the rules don't allow you to do that, to do major upgrades and do all that stuff. So you have to be very, very clear about how you're going to get the funds and whether that fits in. And you need to sit with your accountant and try and see whether they are allowable expenses, whether you can really get into that or not. Unless you can do that, it's not, this is not the structure. There may be trust structures which work there, company structures which work there. That's not the topic for today. You can obviously listen to us when we are talking about those sessions. I think we are doing one on this thing in about 2 or 3 weeks, if I'm not wrong, 3 weeks from now, if I'm not wrong. But yeah, if you are interested in doing that, that's the webinar to attend. But SMSF, if you're looking at doing major changes in construction and that kind of a stuff, not the right tool for you to get into. There are much better and much easier structures to work through. But again, that's a discussion for another day, and that's a discussion for another point.
There's somebody who's saying that I want to rent West, but I'm not sure about buying a house and land package or buying a property, a house somewhere like established house that you're talking about.
Yeah, so for the investing, the first stage will start from the strategy, right? Because when you are investing, that means you would have a goal in your mind. Either in next 10 years, probably you would like to buy a property in Sydney. So that's why you're building a portfolio where you'll have a great equity, or you wanted to build your passive income, or so on. So basically, when you look at the home and land packages, I'm not saying that every home and land package is bad, but home and land packages are always coming into the areas where there is a lot of supply. So if there is a lot of supply and higher demand, so there is a lot of supply and lower demand in that area, in short-term basis, you will not get the equity. When you buy the property in the areas where the supply is lower and demand is higher, you can achieve the short-term growth, which will allow you to withdraw the equity and then buy the next property. Because in the next 10 years, every property will become double. But when you get the short-term growth, so it will allow you to withdraw that equity, so you can jump onto the next property, buy the deposit, and you can enjoy that compound growth. So that's why our preference will be, we'll go towards the only established property in higher demand areas.
I want to buy a house to live in, and what are the first home buyer schemes available for that? Okay, wait. Let me take that one, Julius. I think I have a slide on that as well. Okay. There are, for those who are looking to get the benefit of first home buyer schemes, so government has, and these are state government based or the federal based. There are multiple schemes available for first home buyers who are looking to buy owner occupied properties to live in. There's schemes around stamp duty waiver. You can either get full waiver or partial waiver of stamp duties. This varies as per each state. To give you an example, in NSW, stamp duty up to 800K property is fully waived off. 800K to $1 million, there's partial waiver. Up to above $1 million, there's no waiver. Then there's LMI waivers. They're called first home guarantee schemes. These give you LMI waiver, so you don't have to pay LMI. It will be covered by the government. Those who don't know LMI, it's called Lenders Mortgage Insurance. It is an insurance that you have to take if you're taking a high value of loan. The mandatory insurance that the banks mandate you to take to protect the lender. Okay. But there are also, LMI can be waived off in multiple other ways also, based on your profession, or some banks have LMI waiver schemes going on up to a certain loan amount that you're taking, loan percentage you're taking. Then there are first home grants, where the government is giving grants straight away. These again vary state to state. And so each of these schemes also have eligibility criteria, property price cap criteria and all. So before you go forward and think about the scheme, you discuss with the professional, with the mortgage broker. You can come to us and we can help you understand how the schemes are. And then there is a first home super saver scheme, which is that you contribute voluntarily to the super, and that money can be used towards your purchasing of the first property. And that basically, yeah, you save some money on tax there. These are some first home buyer schemes. There is some benefit available, definitely, and the government is doing its best to help people buy their first home. Having said that, you need to weigh off the benefit you are getting by the first home schemes, and weigh it off, because there's always a trade-off. If you're getting this benefit, then you are buying a certain kind of property. So you always, like we were discussing earlier, that you have to weigh it off against what kind of property you're able to buy using the first home schemes, versus if you buy something else where you may not get first home schemes. That is the trade-off that has to be done, right? And that's where when we have a one-on-one meeting, we can help you based on your personalized scenario, that which one can work, what kind of numbers will be there.
One does not need to refi for 30 years, right? If they go for shorter, will they still overpay? A good question. So see, a lot of times we feel that, okay, if I am able to reduce my term, so let's say at the end of 2 years of my 30 years term, and I start at 28 years, will that not happen? It will happen at a lower extent, because what's happening is, just remember that bar graph which I showed, that curve which I showed, still starts from that steep interest rate payment wherever you start off. As soon as you start afresh, it's not that if you were at a lower point where interest component was lower, and if you're starting at that term, you start there, you're still starting at a huge interest component. That's how amortization schedules work. There will be a point where you can take, okay, if you move from a 30 years to a 20-year loan term, you definitely save money. But if you are already at 28 and you start at 28, but then you would have started again at a point where the principal would be lower, so it's not as beneficial. So you need to do your calculation. You need to see whether a 28 at the end of 28 term when you're refinancing is better for you, or a 25 or a 21 or a 22. And that's what you should really engage with your mortgage broker when you are working out a refinance options with them. Next one, what works better, weekly or fortnightly repayment? All right, yeah. So see, I'll explain the concept of why it works. Okay, when you, it's a bit of a funny thing. It ideally should not have been a difference, but the reason that is a difference is when you have a repayment of, let's say, just to make it easy right now, $2,000 a month for 12 months. So you would be paying 2,000 into 12, 24,000 in a year. But what happens is, in the systems, when you're looking at trying to convert this into a fortnightly repayment, in the first example, then you don't really divide. What you do is, you don't really go and convert this 24,000 into a fortnight. What banks would do is, your monthly repayment, just make it half. So you'll have $1,000, which is going to get paid per fortnight. You have 26 fortnights. So instead of 24 grand, which you should have paid, you pay 26 grand. So without really realizing, you paid one repayment extra in that fortnightly method because of the way the fortnightly money has been calculated. Similar thing happens in weekly. They will divide it into $500 a week as a repayment. Fortnight or weekly mostly becomes the same. That's just because in weekly, if you're paying $500 for 52 weeks, you're still paying $26,000, same as fortnight. So what's really happening is the way the maths is calculated, which benefits a person to save more. Buying IP using trust or in personal name, which one is better for a beginner? See, I'll tell you, a lot of times we have people who will come and tell me, Parag, my borrowing can increase because I want to buy in trust, or I can do this and I can buy in trust. But does a trust really suit you? A different question altogether. And it should really start from there, whether trust will suit me or not. A lot of things come in with trust. So goods and the bad. So for example, The good is that obviously you can buy multiple properties, and if it is positively geared, you can take advantage of lending rules with some of the banks, and you can, if that trust can take care of itself, you can borrow more and buy a bigger portfolio. A lot of people who make large portfolios utilize this because they're making large portfolios. We're talking about a beginner here. Now you have to really see whether you want to make a large portfolio or not. That's something which is a choice. Second is, by making mid trusts, you are now getting into a stage where you'll have a trust cost, then you will not have the gearing benefits on your individual name. You have all these things which come in. You have CGT impact, which is a question which was asked. So you have land tax impact, quite a bit of things which come in, which with the trust. And again, no, not a straight answer, but I would say, as for a beginner, we should think through when we decide, when we discuss upon your strategy. That's what we exactly do. Whether trust suits you or not is something which we'll point out. And if you still want to make a trust and go, why not? But think through on that. What if investment strategy does not work? Then this leverage can go in the opposite direction. Absolutely correct. That's exactly what we were trying to explain. A great investment strategy is important. A strategy which defines what you're going to do, how you're going to invest, where you're going to invest. You just don't invest because my friend has invested. So many times, and we've seen that, so many times people buy because my friend bought there. So many times people buy because my colleague bought there. So many times people buy because I read it in the article. So all that happens, but does that really work? May not be. So what we have to really see is the investment strategy should work. There would be a COVID, there would be things which are unpredictable, nobody knows. But predictably, you should be able to really work through at that point of time when you're planning and doing something. You should be able to see that it's going to work, and it should work. That's what a great strategy is all about. If it doesn't work, then you have to see, which we also discussed in the last webinar, what's the exit strategy? Do we really have an exit strategy or not? Do we have a strategy that I'm going to hold for life, even if it's a bad investment? All that is the risks of investment, which you have to consider when you're building a portfolio and discussing about investment in equity.